Well, good morning. Here we are for our quarterly update on what's going on in the world of finance and the markets. And what wonderful guests I get to speak with every quarter, and certainly in between lots, including yesterday. So we're here today with Bob Diamond, who is the founder and CEO of Atlas Merchant Capital, and his capable and learned partner, who's all things about economics, Larry Kantor. These quarterly calls have become so popular because you two bring amazing, amazing insights. I would say you bring a little bit of a crystal ball to the party too, Larry, because over the last week, during several different updates that I've been privy to, including one yesterday, you predicted what we all just learned, which is that the CPI was going to come in better than anybody thought, and indeed it did. Larry, quick color, tell us about the CPI.
Jim, it's in my, I haven't had a chance, obviously, to look at all the details, but
You've had 3 minutes, Larry. What do you need?
yeah. So the headline came in at 3%. Let's not forget it peaked at 9%. This is the CPI. And the core number was 0.2. We had several months of 0.4 a month, which, annualizes to almost 5%. And we got a 0.2 number on core. And I'll talk about it, but I think you're going to start seeing some better numbers this summer over the next few months. This is just the beginning of a set of inflation numbers that makes the Fed and the markets feel a lot better.
Well, we'll come back to that, Larry, because surely that has consequences on the Fed's behavior. You've been telling us for a year, maybe two now, that all the Fed's actions that they take a while to ripple through the marketplace. So they're a little bit blind on the front end, not really aware of what the consequences of their actions have been. But it almost looks like they're doing their job exactly as they wanted to, which is to guide us to a soft landing and take the froth off this economy. Bob, that has big consequences from a capital formation point of view. Now, the fact that you're a young man doesn't betray the fact that you've seen a couple of different markets. And we've seen capital costs pre-2008. We saw the times now since 2010, where capital has been almost free, which had real consequences. Different parts of the markets behaved in irrational kinds of ways. We saw that back in the dot-com boom, where markets became venture capitalist because you had companies going public with no sight line to turning profitable, but capital was available. So the lines between venture and private equity and public markets all blurred once again. Then we had the Great Reset with the earthquake of COVID. And as Larry has told us now for a couple of years, that there have been aftershocks as a result of that COVID earthquake. And Larry, you told us the last two quarters that if we were in a recession, if there was going to be a recession, we were probably already in it, and it was going to be mild, and it wasn't going to happen everywhere all at once. It was happening by segment. You told us about residential real estate already having its aftershock and already starting to recover. You talked about manufacturing getting kicked in the shins because of the cost of capital. And you talked about the impact on globalization and all of the other aftershocks that came from COVID. Bob, how does it impact the private equity community? You've been focused for us in these quarterly updates on what's going on in the banking sector as a result of this aftershock, the idea of rates going up and some regional banks having some difficulty, money center banks attracting so much more capital. You've been sensitizing to the impact that's going to have on the economy. What do you think? Where do you think we are today?
So, Jimmy, I think it's becoming a more and more healthy environment for investors. And I start, 14 years, quantitative easing, zero interest rates, free capital. That wasn't normal. And I think that had a big impact in leading to the kind of inflation that we had, as did the tremendous fiscal and monetary stimulus that was put in the system. Some of it very needed during COVID, probably some of it overdone. And I think the status quo of 14 years of quantitative easing and zero interest rates and/or not raising aggressively and allowing inflation, as Larry said, peaking at 9% to continue to grow, those would have been the worst scenarios. The current scenario has created some issues. The economy and businesses need to adjust not to zero interest rates, but to now a more normalized curve, more normalized rates. 5% historically isn't even particularly high. And we saw that with SVB and First Republic, right? In the financial services industry, in my mind, two outstanding banks providing great service that got their capital structure way out of kilter, and therefore, were in distress because of the.
And they got it out of kilter, Bob, because they didn't anticipate the Fed broadcast what they were going to do.
Yes.
And did they just not believe it and think buying? How could you go wrong buying treasuries?
You hit the nail right on the head, Jimmy. This is probably the best advertised rate rise in the history of any economy that we follow. They said we are going to aggressively raise rates, and they simply did not adjust. They didn't manage it well, and we're going to see things like that outside of financial services, which is why we're so excited about our credit opportunity fund and looking at good companies in other sectors that have just mismanaged their asset liability match or their balance sheet. And there's going to be opportunities to invest in some really, really good businesses that need help managing themselves better in an environment of higher interest rates and steeper curves. On balance, this is better for the economy. This is more normal. This is life we have to live with, but getting from there to here is going to take some adjustment.
So another aftershock, but for all of us who are either investing or trying to run a business or trying to manage our family's finances, this is why people turn to the two of you to get this insight. Larry, my opinion, not yours, the Fed saved the world. The fact that we had the Fed as an institution, the envy of the world, it saved the financial markets and ergo maybe social peace back in March of 20 and April when they opened the vault and said, we're the buyer of everything. I think they saved the world's economy. Okay, you've told us that they were slow to take their foot off the gas pedal. And this is a consequence of that now. But you've been very complimentary of the fact that they're looking to do the right thing. And whether they're off by 6 months or a quarter, you predicted their behavior, they broadcast their behavior, you've reinforced that, and now we're seeing good things come from that. As we sit back with our a cup of tea in hand, Larry, give us your insight into where we are today. We all hang on this. We wait to hear this. We're all making decisions based on what we learned from you.
Well, that's nice. Thanks, Jim. We'll see. These things aren't always so easy to forecast, but we've had a good run here, I guess. Just on the Fed, I mean, their big mistake was being very late, as you know, Jim. We were talking about a problem with inflation at least by November of 2021. They continued to keep rates at zero and buy bonds. So they would have had to do less than they ended up having doing by being, 6 months or so late. I mean, they were actually later than that, but in terms of when you could have expected them to recognize this. Anyway, as you said, I mean, things have pretty much panned out according to script. The economy's held up. It's interesting, most analysts now, after predicting recession for about a year, have abandoned their recession forecast. Fed's behaved pretty much as we expected. They paused at the last
Well, if
meeting.
you keep betting on black, eventually it's coming up.
I guess, yeah. And they paused at the last meeting, leaving further rate hikes on the table. With all that background, a lot of Fed comments, the markets are no longer pricing in Fed rate cuts this year, which both Bob and I have been saying. I don't know about how long we've been saying there's not going to be any Fed rate cuts. Markets have finally adjusted to that. Bond yields have moved up to around 4%. Personally, we think they got more to go. Eventually, they'll settle higher, I think, than that, sort of 4 to 5%. The stock market's maintained its strength, although it's notable, and that's despite declining corporate profits, that analysts just over the last month have been raising their profit forecasts. As you've alluded to, Jim, for the past year or so, we've been calling for a sustained period of sluggish growth instead of a recession. It now looks like that sort of phase is over. and that the COVID business cycle, what I'd call the COVID business, is pretty much behind us. You remember it began with a crash in the economy and the markets, followed by a spectacular rebound, which reflected, as you pointed out, unprecedented government stimulus, and Bob mentioned, as well as pent-up demand as people resumed going out and about. Just to give you some numbers on that, GDP fell 30% in the second quarter of 2020, rose nearly as much in the following quarter, and then followed that up by about 6% growth in 2021. We slowed to only 1% last year, after the Fed reversed course and put the squeeze on things. And at the same time, fiscal policy tightened what I would call passively due to the expiration of, most of the COVID stimulus programs. So that's all well and good. And the question is, what's next, which is what I'm always focused on. And
that's why we're all leaning forward, Larry.
We think the next move is up. That's not probably what you've been reading in the newspapers or hearing from your analysts. And I just want to explain why we think the next move is up. I'm talking about for the economy. And the first thing is that Jim, you talked about this a little bit, but the interest rate sensitive cyclical sectors, and I'm talking about manufacturing and housing, they already got crushed last year, and they were largely responsible for the economic slowdown we've been through, and they've bottomed. Housing especially. I mean, you look at every activity data, from sales to construction starts to permits, they've all moved up significantly since the beginning of this year. Manufacturing, and I'm talking about the goods economy at large, it remains in the doldrums. But we think it's likely to improve over the next several months. So just digging into that, the production indicators seem to have stabilized at low levels. But if you look at the demand for goods, final sales of goods, they're doing a bit better. And if you look at inventories, which I look at closely, they've pretty much adjusted here. They're pretty low. You take car sales, which obviously big ticket items. It's a number I like to look at because you have to feel, if you're a consumer, pretty confident. If you're buying a car, that's like the second next to homes, biggest ticket item you're going to buy. They're up 17% this year.
It's still an availability issue, Larry. I hear from people all the time. You're having to pay over
supply side thing. That's true. They couldn't get chips and so forth, but that's production, Jim. You're talking about output. They're producing cars again, and they're selling cars. And so GM sold more cars in the second quarter than they have in any quarter in 2 years. So this is it matters whether it's, the demand's been there, as you say, Jim. That's part of the reason I'll talk about inflation and used cars prices. But you're starting to see production. Production means employment. Employment means income, et cetera. Meanwhile, you look at the service sector, and that remains very strong, and I think still has some legs as people are continuing to make up for lost time that they experienced during the pandemic.
Service, Larry, is things like travel, recreational spend, restaurants.
Right. Restaurants go into, restaurants, they're packed. Leisure and hospitality, you're talking about hotels, transportation, all that stuff. And it's being bolstered by, we still see continued job growth, even then it's slowing. And here's an important fact. Wages, I'm going to get to inflation. We said it peaked, CPI peaked at 9%. This number was 3%. And wages are now growing faster than inflation. Now think of that from the consumer point of view, that's real income. And that's supporting consumer spending. So you've still got this circular flow of jobs.
It's been the opposite, right, Larry?
Spending. Yes, that's right. Before, inflation was exceeding wages. Now it's coming through the other way. Also, keep in mind, I think I've mentioned in previous reports, that during the pandemic, with all the support the government was providing and the fact that people were staying away from traveling, going out to restaurants, they built up over $2 trillion in excess savings. That has not been fully exhausted. We estimate, and San Francisco Fed just came out with a paper, there's still about $500 billion left there. So that's also
of the
supporting.
of the 2 trillion in excess savings that accumulated in 2021 and 22, there's still a quarter of a trillion left.
Exactly. And so people
Or
are
half a
still
trillion.
drawing that on that. So in addition to the wages and the job growth, so people are wondering, wait, why is the consumer holding up so well? Well, there you go. Now, you might think, and this is important, that a rebound in economic activity is going to prompt the Fed to hike rates significantly further. But that's probably not the case, at least, for this year. I mean, it's true, as I said before, markets are no longer pricing in Fed rate cuts this year. And also, they've perceived recent comments by Fed officials as hawkish. I mean, Powell, one thing that I thought was very notable, Powell, I think a couple of weeks ago, he testified before Congress, and somebody asked him a question, and he said, probably 2 more rate hikes this year are probably a good guess. And then they came out with minutes of the last FOMC meeting that showed, despite the fact they paused, that several members had wanted to hike rates. And right now, and I haven't looked since the CPI numbers came out because it was just before this call, but basically markets are now pricing in another quarter% hike in the next meeting, which is the end of this month. That may happen. But here's another important thing that I think markets may have overlooked a little bit.
At the moment, Larry, the Dow is up over 300.
Right. Yeah, after that number. I was saying before we got on this call, it would be nice if CPI was tomorrow. But anyway, because I was
so that you could take credit, but we're giving you full credit. Bob and I are here to testify that as recently as yesterday, you said it was going to be 3-3.1, and boy, you were spot on.
Right. And a lot of analysts thought the CPI number was going to be soft. I'm not sure how many are holding on to the idea that this is the first month of several that are going to deliver very good news. But just back to Powell. Yes, he sounded hawkish because markets were pricing in Fed rate cuts. But he also indicated that they're going to be patient about this 2% target, which I was concerned about because I don't think we're getting down to 2% core inflation anytime soon. He said it's going to be a long process. And he said something that I really opened my eyes. And he said he doesn't think we're going to get there this year or next. And that suggests to me that the Fed's going to be satisfied just seeing progress toward its objective over the next year or two. So the big
well, Larry, let me ask you to pause on that thought because both you and Bob have mentioned on this broadcast at Worth, our quarterly financial update, that the important thing to pay attention to for us trying to make plans and take our best guesses as to what's going on in the economy, that the important number isn't what the inflation number is. It's the predictability. It's the stability that you'd rather have a 3 to 4% inflation number if we could be certain that it was going to be in that range for a couple of years, that you thought Bob has expressed that his businesses can adjust to that. So the more important number isn't the actual number, it's the stability of the number.
That's right. I mean, look, when you get to numbers like 8, 9%, that implies instability because there's a very high correlation between level and stability. So once you get, I'm not talking about, I don't think we'd be in a good shape if we're 5% or higher, but there's nothing special about 2%. I mean, there's not like a whole bunch of economic research that says that's ideal.
Free and steady state would be good for the economy, you think?
And it was there for a long time. We had before the financial crisis, 3 to 4 is fine. I think I mentioned last time when Paul Volcker left the Fed in August 1987, inflation was over 4%, and everybody was very happy about that. Now, of course, it had been in double digits, but it wasn't a problem. Greenspan resisted setting any inflation target at all.
Larry, we hear that countries and zones that have control of their currencies can inflate their way out of debt. What does that mean to us? So is inflation at some level a friend to an overspending economy like we are?
No, I don't think that. I don't see. For one reason, whatever outstanding debt you have, the higher the interest rates, the more we have to pay for that debt. I don't know if you know this, but the Fed typically makes profits every year, right? They create money and get interest on the debt they hold, and they transfer that excess to the Treasury. I was going to talk about the deficit in a minute, but um, uh, lately they've been taking losses on the bond portfolio, and they're not sending over that money to. So no,
just like SVB.
it's a way. Say you can inflate yourself out of a recession, but not out of inflation. That at some point, this whole I don't know if you remember when we did QE the first time in the financial crisis, and inflation didn't show up. There was this crazy thing called modern monetary theory, which, by the way, since inflation, you haven't heard a word about it. This idea we can inflate as much as we want, not have to worry about it, which was never really, it was overstating it to even call it a theory. I didn't know an economist that actually developed this. So that's sort of been, so that, no, I wouldn't buy. But what I'd like to do, Jim, is just talk about why do we think inflation is going to settle here in a nice way over the next few months, and have some welcome news here, because I've already said I think the next move is up in terms of economic activity. I'm not talking about a boom, but we've been in a 1% environment. We're going to be at least 2 to 3%, I think, in terms of economic activity, and that's not what the consensus is saying. So let me just go through a couple of things on inflation.
Say we, you're talking about the U.S. there, Larry.
Yeah, I'm talking about the U.S. And I know you probably want to talk about, we could talk about after this, China or Europe. I'm happy to discuss that. But I am talking about the U.S. We already said headline inflation. I mean, CPI coming from 9 to 3. And by the way, it peaked in June of 2022. You're talking about a year ago. That's unbelievable. Now, a lot of that was energy prices. Oil came way down. Some of it lately has been food prices too, but the Fed focuses, their target is on core inflation. Even core is looking better. We just got a number this morning on core, which was 4.8%, and that peaked and from 6.6% a year or so ago. And by the way, one good news is that over the last few months, it's been growing more like 4% in core. By the way, the Fed targets a different inflation figure, the personal consumption expenditure deflator. I don't mean to get too esoteric here. That comes out at the end of the month. But we should get softer numbers there too. Those have been running actually a little less than the CPI. So that's still above 2%, right? 4% core inflation, or 4.8 year on year. But here's the reasons why we're going to get better. One is used car prices. So as we were talking before, car makers were shutting down factories. They couldn't get chips. They couldn't get other parts. And so the money went into used car prices soared. Well, they've been dropping like a rock here over the last month or two, and it hasn't shown up yet. I haven't had a chance because the CPI just came out to look at those numbers, but you're going to see that over the next few months. We had the China COVID shutdown. There was a lull in global chip production. That's improved. Seasonal factors, and I don't want to go into them, but everything's seasonally adjusted. We had a couple of summers during COVID where things picked up, after the winter, and prices shot up. And that's in the seasonals now. So the seasonal are going to act to push down inflation numbers, meaning they've been exaggerated on the upside in some of this winter and spring numbers. So that's going to help. Shelter costs, I've talked a lot about that. Just to give you some idea, rents were inflating at a pace of 20% in mid-2021. Over the last 8 months, they've been rising at about 1%. The inflation data takes a 6-month average, so that lags. So that's an easy call. You're going to see shelter. It's already started coming down. My guess, you saw a softer number this morning. Again, I didn't have a chance to go through all of the tables, but that's going to be a factor softening inflation. Just say a word about wage growth and then wrap it up. That's clearly a concern for the Fed. We still have a massive labor shortage, tight labor markets, an unemployment rate that's basically a full employment. And recently, wage growth has accelerated. But it was running, as I said before, well below inflation. And I would characterize this recent acceleration as just catch up. And with headline inflation having fallen sharply, that wage acceleration is going to be short lived. So if you look at average hourly earnings, which is what it's not a perfect measure, but we get it every month, that ran at an annual rate of 3.5% in the first quarter, despite much higher inflation. It accelerated about a percentage point in the second quarter. So it's running around 4.5. But if you consider that wage growth typically exceeds inflation by at least a percentage point because of productivity growth, 4.5% is not a major concern. I mean, that's consistent with inflation of about 3%. So I don't think it's going to be a major concern. So the bottom line here, Jim, just to wrap it up, is that the economy looks to be in a recovery phase from a period of very sluggish growth. I'm not talking about a boom. And that forthcoming inflation numbers should provide some comfort. And look, I don't have to tell you that's a pretty attractive combination. And that, I think, could well account for what the strength you're seeing in the stock market. So I didn't talk about Europe, UK, and China. I don't know if you want to talk about that, Jim, but that's it for me.
Well, Bob, I'd like to pick at that just a little bit. China reopened. We expected to have a lot of pressure on energy costs as they geared back up manufacturing, consumer spending. They've only grown 1%. 1% growth for the U.S. We're saying, thank God it wasn't a recession. But 1% growth in China, that's frightening.
You know, Jim, I look back to when you were building 1-800-Flowers and I was building the businesses at Barclays, and we could count on the fact for, well over a decade that global growth was really led by China. And I recall, that sense of panic when they got down to kind of 6 or 7% growth. And now they're basically flat. And the impact of the policies that China implemented during COVID are really working against the economic growth there. And this is going to have an impact on the world. So I think it's not anything any of us had expected that China at this point of the cycle would have pretty much zero growth.
Tell us about Belt and Road. They put this money all over the world. We were concerned, Larry, that they were buying influence all over the world, especially in Africa, the mineral and natural resources rich Africa. Now it's looking like a huge liability.
They're going to have some issues with that going forward, as you pointed out. No, the only thing I wanted to clarify, because we were talking yesterday about China, that 1% isn't really a forecast. So in other words, first of all, China reports only year on year, but you interpolate quarter on quarter. I'm just saying, if you look at the second quarter numbers, which, it's looking like on a quarter on quarter basis, it's going to be about 1%. And that's annualized. So as Bob said, barely grown. Because remember, what happened is they had the zero COVID policy in place. They sort of crashed. Then they took that off. And we had a bit of a rebound there early this year in China, but that has faded dramatically. I mean, they've got all kinds of credit issues. Property market's doing terrible. They've also, Jim, I remember yesterday we were talking, you're pointing out a demographic problem, which is a great point. They're coming into, this is a long-term issue, but, you go from massive population growth to a one-child policy, and then you take that out a few decades, you're going to have a lot of retirees and nobody working there to pay for them. So
public policy has consequences.
It really does. And I'm just saying that I think when you see some of the China numbers going forward here, as Bob said, it's going to look like they're barely growing. Also, by the way, inflation, there's like no inflation there. I mean, their export markets being hurt. Companies, especially in the US, but all over the world, are diversifying their supply chains, not just depending on China, going to other Asian countries, Vietnam, Thailand, going to Mexico and so forth. And they've put a lot of restrictions, further restrictions on companies operating there who are pulling out. So I think you're going to see a big fiscal stimulus package here this summer, which will pop them up. But the general trend there, just as Bob said, I mean, the idea that they're the massive growth engine, and for a long time they were growing at a double-digit rate. I think that's going out the window here.
Well, I think what we can take away from you fellas today is heartening, and that is your forecasts have been spot on, Larry. Bob, your interpretation of what the macro influences will be on businesses in general. Certainly, we can see from your behavior at Atlas Merchant Capital in creating a portfolio that serves your clients, many of which are sovereign wealth funds who are looking for diversified opportunities that can move and manage their risk and take advantage of opportunities, which is why your credit fund is so hot right now, because they take advantage of these aftershocks that are going through the market and providing capital on a very risk-adjusted, attractive basis. So to sit back and see Larry quite accurately forecasting what's happened and now forecasting forward, that you're going to see inflation come in that 3 to 4% range. It's going to be fairly steady. That's a good thing. Auto costs have been coming down. The consumer is healthy. Of the $2 trillion excess savings that came about as a result of all the stimulus programs and savings and lack of spending, there's still $500 billion of that left. So the consumer's in good shape. Shelter costs have plummeted. Money is going back into real estate, particularly in the rental market. Labor is available, still a large shortage, but now for the first time in a long time, workers are seeing their wages rise faster than inflation. That all sounds pretty good to me. So I think as a small businessman working with a bunch of businesses in my world, Bob, you work with a whole portfolio of companies. I think it's you have to pick your spots, but it looks like a fairly good playing field in the quarter ahead.
Yep. Pretty good. You phrased it correctly, Jimmy.
Larry, Bob, thanks. We hang on your insights. We love to have contact with you. You give us great insight into how to adjust our capital. Here at Flowers, we're talking about the fact that we're recovering from the earthquake of COVID, the aftershocks, and while top line isn't easily grown, we expect to be more profitable each of the next several years. So it's because we're doing some things right, yes, but mostly the macro headwinds that you've told us about, Larry, are starting to come back to revert more toward the norm.
Thanks, Jimmy.
Thank you, fellas. We look forward to next quarter and anything we can learn from you in between. Thanks for helping us out so much.